Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equities Strategist. Along with my colleagues bringing you a variety of perspectives, today I'll be talking about the impact of better economic growth and stickier inflation on stocks. It's Monday, April 22nd at 11:30 a.m. in New York. So let's get after it. In our first note of the year, I cited three potential macro outcomes for 2024 with similar probability of occurring. First, a soft landing with slowing below potential GDP growth and falling inflation toward the Fed's target of 2%. Second, a no landing scenario under which GDP growth reaccelerated with stickier inflation. And third, a hard landing or recession. Of course, each scenario has very different implications for asset prices generally and equity leadership specifically. Just a few months ago, the consensus view skewed heavily toward a soft landing. However, the macro data have started to support the no landing outcome, with recent growth and inflation data exceeding most forecasters' expectations, including the Fed's. Over the past year, consensus views have gone from hard landing in the first quarter of 2023 to soft landing in the second quarter, back to hard landing in the third quarter, to soft landing in the fourth quarter, and now to no landing currently. This shift has not been lost on markets, with assets that benefit from higher inflation doing well over the past few months. However, while cyclically sensitive stocks and sectors have started to outperform, quality remains a key attribute for the leaders. We think this combination of quality and cyclical factors makes sense in the context of what is still a later rather than early cycle reacceleration and growth. If it was more the latter, we would not be observing such persistent underperformance of low-quality cyclicals and small caps. Furthermore, we continue to believe much of the upside in economic growth over the past year has been the result of government spending, funded by growing budget deficits. This has led to a crowding out of many smaller and lower-quality businesses, and the lowest small business sentiment since 2012. As with most fiscal stimulus packages, the plan is for the bridge of support to buy time until a more durable growth outcome arrives, driven by organic private income and consumption and spending. Until this potential outcome is more solidified, the equity market should continue to trade with a quality bias. The largest risk for stocks more broadly is higher 10-year Treasury yields as investors begin to demand a larger term premium due to higher inflation and growing supply of bonds to pay for the endless deficits. While leadership within the equity market continues to broaden towards cyclicals, it still makes sense to stay up the quality curve. Our recent upgrade of large cap energy fits the shifting narrative to the no landing outcome, and it remains one of the cheapest ways to get exposure to the reflation theme. Other reflation trades are more extended in our view. Our primary concern for equities at this point is that aggressive fiscal spending has led to better economic growth, but it keeps upward pressure on inflation and prevents the Fed from cutting interest rates that many economic participants desperately need at this point. In short, a no-landing outcome may make the crowding out problem even worse for smaller businesses, many consumers, and even regional banks. This is all in line with our 2024 outlook that suggests the major equity indices are overvalued, while the best opportunities are likely beneath the surface in underappreciated sectors like energy that are positively levered to stickier inflation and higher interest rates. Thanks for listening. If you enjoyed Thoughts on the Market, please leave us a review wherever you listen to podcasts and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.